Hello everybody, Professor Jay here, and today we're going to talk about gains and losses on sale of long-term assets. What you're looking at here is sort of a balance sheet situation where you see the T accounts under assets, liabilities, and stockholders' equity. And under assets, we have a truck that we bought for $25,000 with its associated contra account for accumulated depreciation. And to date, we have depreciated it $10,000. We also happen to have a note payable under liabilities that's for that truck that we still owe $15,000 on. So, in scenario one, how do we handle it if we've had the truck a couple of years, we decide to sell the truck, and we find a buyer who's willing to pay us $20,000? How do we go about dealing with that? Well, first of all, scenario number one, we would say, what are they going to do? Let's say they pay us cash, $20,000 cash. Well, obviously, we're going to have to debit cash for $20,000 because we received cash. But now we have truck and accumulated depreciation still sitting on our books. We have to get rid of that. And how do we get rid of something that's sitting on our books? We zero it out by doing the opposite of what's sitting on it. So we are going to credit the truck account for $25,000, which zeroes it out, and we're going to debit the accumulated depreciation for the truck by $10,000. Those are both zeroed out. But we have an issue. Our debits total $20,000 for cash and $10,000 for accumulated depreciation. So we have $30,000 of debits right now and only $25,000 of credits. We obviously need a $5,000 credit. Well, guess what? Gain on sale comes to the rescue. First of all, under stockholders' equity, you're used to seeing revenue accounts and expense accounts. Well, revenues and expenses are reserved for those things we're in business to make revenues or write off expenses for. For example, selling our inventory. We gain revenues and then we get to expense our cost of goods sold and any other expenses we had in selling that inventory. But we're not in business to sell the company truck. So we're not allowed to call that a revenue or expense. So we use the terms gain or loss. They function just like revenues and expenses. They're debited and credited the same way. However, we have to call them gain on sale or loss on sale. So in this case, we made money. Our truck made a $5,000 gain on that sale, and that's where our credit is. Just like you credit revenues, you credit gains. Now let me show you how you could have determined that without going through all that. All sales are compared to net book value. The net book value of this asset is the truck account minus its accumulated depreciation. So the net book value, if you take the green writing, of this truck was $15,000. We sold it for $20,000. So that right there should have told us you made a $5,000 gain on the sale. So that's a much faster way. We always compare to net book value, any kind of sales. So now let's talk about the other scenario. In scenario 2, we sell the truck for $5,000. Once again, our net book value is $15,000. So we already know we're selling for a $10,000 loss. But how do we actually go about putting that on our books? Okay, very similar to the other one. We receive $5,000 in cash for our truck. We must have been pretty desperate. But we debit cash for $5,000. And once again, we have to close out the truck and the accumulated depreciation truck accounts because we no longer own the truck. So, Same as before, we credit truck $25,000 and we debit accumulated depreciation for the truck, the $10,000, so that goes away. And you will find that now, look at our debits, are only $15,000 and our credit is $25,000. We are going to need to debit something for $10,000, and sure enough, we debit losses. Just like we debit expenses, we debit losses, and now our debits equal our credits, and everything's still in balance. The only thing that you may think is a little odd is that we still have the note payable for the truck. Well, just because we sold the truck doesn't mean we don't owe the bank for it. What we do with the cash we received is up to us. We can pay off our note payable, or at least pay off part of it, or we can go buy a boat with it. It's up to us. That note payable is not touched by selling the asset that we had the note payable for. So, there you go. Gains and losses on sale of a truck. Not too hard a concept. Remember, just always compare what you sell it for to net book value, and that will determine your gains or your losses. See you in the next video.